From a demand perspective, sure, people are continuing to travel post-COVID. I think COVID unleashed this you only live once mentality, and I think a lot of people are continuing to travel as a result of that and want to get out and experience the world. We've seen a return of international travel to New York City, which is a significant demand driver in this market. Interestingly, the Chinese, which historically have been the second largest foreign demand group, they recently relaxed their group travel restrictions, which is a big driver of traction of travel to New York City from an international perspective. So we expect to see significant inbound Chinese travel, as well as from some of the other foreign jurisdictions. The other dynamics that we're seeing, return to the office and return of business travelers coming back to New York, staying in hotels, group travel, meetings taking place, which is also driving demand. From a supply perspective, a couple things taking place. We've had a significant influx of new hotels over the past 10 or 12 years in New York City, which we expect that influx to decline pretty significantly. There was a legislative initiative passed several years ago, which makes it much more difficult to build new hotels in New York City. You effectively need City Planning Commission approval to get a new hotel built, which makes it a lot harder to build new hotels. So ultimately, there will likely be fewer new hotels built. Also, Airbnb, the city passed regulations which make it more difficult for homeowners to essentially put their properties on Airbnb. So we've seen a meaningful decline in Airbnb as a result.
So an investor who wants to capture some of this upside potential, what do they do?
Look, there are properties certainly on the market. We expect that there will be a lot more properties on the market over the next 12 months for sale, which should drive significant volume. And interestingly, in 2023, we've actually had a meaningful uptick in investment sales activity. Almost $3 billion of hotels have sold in New York City, which is a record. That's October year to date, which is a record relative going back to 2015. So we haven't had this strong of an investment year since 2015. A lot of the reason ties into a couple of things that we talked about before. Difficult to build, hard to build, a lot of demand for people wanting to come to New York City and stay in hotels. So that's a trend that we expect will continue well into 2024.
Yeah, so let's recap on this, what you just said here, Kevin, because I heard that all of the demand indicators look like they're going up. A lot of the supply ones are going down.
Correct.
That sounds like a nice recipe for inflation.
Well,
for higher hotel rates, at least.
Higher hotel rates. How's that? Now,
Okay.
Look, the other side of that is, labor costs have gone up, so it's certainly more expensive to operate a hotel in New York City.
Again, we can pass those on through taxes, the higher hotel rates.
That is certainly possible in some instances. But yes, there have been higher costs, but obviously rates across the city are at record highs. Look, the other dynamic that we're seeing, about 12% of the hotel rooms in New York City are being leased out to migrants. So that's a fair number of rooms. Call it 17,000 hotel rooms in New York City are actually effectively offline because they're being used by the migrants.